Hello and welcome to Views from the Top, a Livewire series where we bring you the insights from investment leaders in their areas of expertise. My guest today is Shane Fitzgerald, who's a portfolio manager of the Monash Small Companies Fund, and as the name suggests, he's an expert in investing in small companies on the ASX. Shane, good to see you. Welcome.
Good to see you. Nice to be here.
Now, we're on the back of 11 straight interest rate hikes, or 10 plus 1.
Yep.
Drumbeats of recession are beating loud.
Correct.
How's this environment impacting the small company sector where you invest?
Yeah, I think the biggest impact it's really had on the marketplace, particularly the small companies, is just how much the time horizon of the market is crunched in. And this normally happens when you have an environment like we've seen. There's a lot of uncertainty out there. So people aren't willing to look out 6, 12, 24 months like we were, say, 2 or 3 years ago. So that time horizon coming in is really been the big factor.
Okay. You have to keep investing throughout this environment, regardless of what others are doing. And the backdrop is having an impact on small companies.
Yep.
How's it impacting the way you invest?
It hasn't really changed the way we invest. Probably with one exception is we probably put a lot more focus on the liquidity of the stock these days than what we did a few years back, right?
Yep.
We want to be sure that we're investing in these companies. If something does go wrong, we can get out of these investments. So, the environment, when you have an uncertainty in the environment or the economic growth is what it is, what we're about at Monash Investors is finding companies, truly great companies, are going to have some sort of step change in their prospects. Yeah. Now, if the economy is good or bad, that step change is still going to occur if we're right in our analysis. It just might take longer to be reflected in the share price than what is normally the case. Okay,
we're going to come back to company specifics in just a little bit, but as I mentioned, you specialise in small cap stocks. When I zoom out and have a look at the small cap index, over the past 5 years, it's gone nowhere. It's barely done anything.
Right.
And so I guess I'm keen to know what's the appeal of that part of the market for you, given that broad index backdrop.
Yeah, look, the key in small caps has always been and will always be a stock picker's market, right? You've got to do your work, right? It's all about identifying those great companies, those great management teams, and investing in those. So, over the last 5 years, the Monash Fund's up 10% per annum over that period of time. It's a testament to the stock picking ability that we and other small cap managers have. Active management in small caps really does work.
Okay. Your process, when I was having a look through the overview of what you're doing, it says you're targeting companies that can deliver 60% upside, which sounds like an attractive but also a very specific number.
Correct.
Talk me through the mechanics of that and why you've picked that number.
Yeah, I think that number is really, it's sort of shorthand for us saying what we're looking for is companies where we can see significant upside in those companies. Like, I don't want to get into a battle about the last 10% in the valuation, right? Because we're really in a battle about, is my model better than yours? I more accurately forecast whether sales growth will be 6 or 7% per annum. That's not our game. Our game is to look for those big valuation upsides. So 6% is a number where what it really reflects is if we form a view about a company and its prospects, and the market shared our view about the prospects for the company, it'll be trading 60+% higher today, if that was the case. They're the style of companies we're looking for. And 60%, it's a somewhat arbitrary number, but it's a number over the last 12 years we've found tends to be the one that works best for us.
Okay. Well, let's talk more into the mechanics of your process. What goes into identifying those companies? What are the steps that you will put a company through to find that one that ticks the boxes?
Well, a lot of shoe leather is the short answer. We have to go and see a lot of companies. You got to get close to the management team. You got to understand what they're about, what their drivers are, and what they're going to do. But it's really what we really draw upon at Monash is revisiting recurring business situations and patterns of behaviour, right? We've often seen things like store rollout programs, new product launches, geographic expansion. On the negative side, sudden management change can be really strong signals about prospects for companies. So what we tend to do is we analyse companies, we go to presentations, we go to conferences, we listen about lots and lots of stories, and it's like everything. You got to kiss a lot of frogs to find the prince, right? And that's what we try to do is do that detailed work, lots of homework to find those opportunities and invest in them.
And in terms of fundamentals, are there specific criteria that you're looking out for to either include stocks for deeper research or to knock stocks out, like a revenue or a profitability or an ROE number? Are there any particular metrics that you apply in your process?
Not particularly. It all comes back to that 60% valuation upside, right? So what it's about is when we hear a news story, positive or negative, is that what's happening in that company significant enough that's going to really change the valuation of the company? If we think we've found that, that's when we'll do our deep dive modelling work. That's when we'll talk to the company, talk to some of its competitors if we can, talk to all the analysts in the market covering the stock and get a sense of where the market is on this company. And then we can form an opinion about whether we're right about whether there is material valuation upside in the business.
Okay. Just staying with what's happening at the small cap level, I saw some numbers come out recently that small caps have been underperforming large caps by a factor of about 22% since the end of December 2021.
Yep.
What do you think would be a catalyst that would see small caps regain or close that gap between large caps?
Well, I think part of the answer is in the question. The fact that they've underperformed by 22% is, by any historical measure, very extreme. And these extremes don't stay, they snap back. I really think the difference is, for the last couple of years, the market's been driven by macro factors. Rising interest rates, rising inflation, right? This occurs across all the stocks in the marketplace. And with that uncertainty, the market has contracted its investment time horizon and gone for the high liquidity stocks. So it's gone up into the large cap space. So you had a weight of money shifting out of small caps into the large caps. Where are we now? Well, if you look at, I don't hear many companies talking about supply chain problems anymore.
Yeah.
So what was the root cause of the inflation surge? Supply chain. That's mitigating it now. If that's mitigating, we're probably at the tail end of the interest rate rises. So all the uncertainty about the economy is starting to dissipate now. So I do think we're moving much more into that stock pickers market now, and it's that sort of market which companies like Monash Investors can shine.
How can you best take advantage of what you talked about? You said it's a stock pickers market.
Yep.
The macro is dissipating. How does Monash set itself up to take advantage of a closing of the gap between small cap and large cap performance?
Well, look, we've always invested in the small cap market. The 12 years we've been in operation, I think it's 91% of all the investments we've made have been in the small cap, and we've done pretty well doing that. So the answer to the question is nothing much changes. We continue to do our work. We continue to take lots of company meetings. We continue to look for those step changes in companies, and when we find them, we invest in them. And that's why we've always done it and always will do. It's what's repeatable about the process.
Okay. And what about at the sector level as we sit here in the market? What looks good? What looks bad? What looks ugly? Can you talk me through any particular tilts in the sectors? Because we've seen retailers getting smashed, poor retail sentiment.
Yep.
What are you saying?
Yeah, look, I think at the moment, coming to this reporting season, retail is probably going to be a pretty hot focused area. There's an underlying expectation the consumer is quite weak at the moment, which is true. All the anecdotal evidence says that's the case. But is it as bad as the market expects? That's going to be the key here, right? Yep. So I suspect the retailers might actually do a little bit better than what the market's anticipating. Right? Yep. The market's already assuming.
It's about expectations, right?
Expectations are rock bottom at the moment, right? But in terms of more broader sectors, I don't spend a lot of time, for example, thinking about banks or consumer staples or REITs. These aren't businesses where you're going to see some sort of material step change in the operations of these businesses. So it's more about focusing in the general industrial areas, the IT, and also the consumer discretionary and the healthcare sectors. There tends to be sectors that we find the best opportunity sets in.
Okay. Well, let's talk about the stocks, because you said that's where you guys hit your stripes, is picking stocks. Could you talk me through a few examples of stocks that have that 60% upside sort of target that you at Monash look for?
Yeah, sure. So I brought 3 different names I thought we could talk about. One's a big cap, a sort of mid cap, and a resource name. So in the big cap space, one stock that we really like at the moment is QBE. Yep. QBE, everyone knows who QBE, big global insurance company. But QBE has been raising its premium rates now. All commercial lines insurers have been raising their premium rates for a good 4 or 5 years. All right, their rates increases are above the rate of inflation. That should lead to margin expansion. We haven't seen that just yet in these businesses because they've been rebuilding their balance sheet reserves and building them up. That's now largely run its course. So when I see QB at the moment, I can see this business continue to do top line growth around about 10% per annum. It should have an expanding margin outlook. and it's trading at about a 30% PE discount to its historical range. So I'm getting above market growth, below market multiple, that leaves upside. Another stock that we've got in the portfolio, and we've spoken about this company quite a lot on Livewire. It just kind of sort of shows how much we like it. But Telix Pharmaceuticals, it is really in the sweet spot of new information flow coming through. Its prostate imaging product is really smashing it out in the US at the moment, growing incredibly quickly, and its new renal cancer imaging product is about to launch in the coming months, right? That product has, every time I look at that, there seems to be more indication, bigger, the TAM seems to be growing and growing and growing.
Yep.
In the next 9 months or so, we'll see the first studies, phase 3 studies coming out with regards to the therapies. Now, if some of those therapies work, that's a game changer. The price you get on a therapy is 10 times what you get on the imaging product, right?
Yeah, wow.
So it could really be a game changer for that business. And the third one I brought along was in the resource space, Leo Lithium. Now, I don't know whether the spodumene price is going to go to material highs from where we are now or not, but what I do know is the amount of lithium the world needs continues to grow and grow and grow. Leo is sitting on the 5th biggest resource in the world, and they haven't finished drilling that out. It's got a 30-year mine life on the current resource. It's going to grow to 40, 50, 60-year mine life. What that really means is they're going to have the ability to go to stage 3 of that product, of that mine, and probably double the production. That's the step change for this business. Its only problem is the mine is located in West Africa. It'll always trade at a discount because of that, but right here, right now, that discount's excessive.
Do you think, given the takeover activity that's taking place and the corporate activity in the lithium space, it could become subject to interest from a larger player?
I think absolutely. I think industry players will have less of a concern for the geographical location of the mine and look at more of what the mine is, the attributes of the mine. They can manage governmental risk and the like themselves. So I think that it is certainly a takeover candidate.
Well, Shane, thanks very much for coming in and talking to us today about small caps. For all you viewers out there, I hope you enjoyed that episode of Views from the Top, a deep dive into the small cap sector with Shane Fitzgerald from Monash Investors.